2021 has been a very unusual year this year. It's a classic British understatement. And of course, it's been for everyone around the world from a number of angles, a year of discovery scientifically for sure. As the late US Defense Secretary Donald Rumsfeld once said, there are known knowns, but it is the known unknowns that we take with us into 2022 as COVID continues to spring all sorts of surprises on us. What does it all mean from a market perspective? Well, Tim Price joins us now from Price Value Partners. Tim, it's good to catch up with you as we look into 2022. I know we're going to be discussing all aspects of the markets, but I want to begin first of all with how you feel as a money manager going into 2022. What do you consider to be the known knowns that we know about, which are already in the market, and how do you think that could change as things develop?
I mean, the known knowns, unfortunately, are things we'd rather not know about because they're effectively the rise of the resurgence of the big state. So the big state is back and is gleefully jumping into a load of puddles at its size 12s. And that's impacting on all kinds of markets and not necessarily in a very good way. The one market that we're most concerned about would be the bond market, which is one of the largest asset markets in the world. We find bonds now uninvestable. So we're basically, the bond market is basically being prodded with, like barge poles. It's so unpopular. This is a very uncomfortable environment. This is a world that we'd ideally not be in, but we have to play the hand we're dealt.
But it seems to me, though, that in fact, from another angle, it is actually quite a comfortable place to be, because it seems to me as though central banks and governments are quite happy just piling money in. I mean, that's good, isn't it? I mean, it fuels more upside potentially in the equity markets, at least.
It does raise the question of whether this is a sort of false wealth creation, though. So just before we came on air, we were discussing the fact that of all of the US dollars that have ever existed, 25% of them have been printed in the last 12 months. That is a staggering statistic.
That means, doesn't it, that the dollar has been devalued by, 25% over the last year. Now, that is, as you say, an enormous amount of money having been printed. But we're not seeing that yet in inflation. There's some hint that inflation is beginning to pick up. There's a lot of debate on whether it's transitory or becoming entrenched. But, OK, we're going to have to get used to inflation, which we already had before. It's just that we've got so used to very low or no inflation. So how do you see inflation developing over the next year?
Well, the perspective of the classical economists would be that the inflation's already happened. So inflation is classically defined as an increase in base money. Well, that's already here. That's already been the case for years now. We've had aggressive money printing, at least going back to the 2008 crisis, if not before that. So the inflation's baked in the pie. The only question is, as the velocity of money ebbs and flows, do we start to see a second order impact in the rise of prices of goods and services? I doubt whether anybody believes the official government inflation figures anyway, because they're nonsense. So our job as asset managers is to try and protect the real value of our client assets as best we can. That in a world in which, as you've already highlighted, you've got extraordinary money printing, extraordinary amounts of liquidity being funneled into markets, it's a question of knowing what's real value and what's Potemkin village value. So this is a world, although it seems easy because the money being pumped in is making everything go up. The reality is we think we need to be extraordinarily careful about being selective about which assets we choose to buy.
Well, let's explore that a bit more, because I think obviously that's going to be key to wealth creation. What do we chase into 2022? What should we be holding? What should we be dumping? And how is this going to affect the trajectory of the markets that we've seen pretty much throughout 2021, which has been highlighted by record after record after record coming through in the traditional old cap stocks? We've got the Dow at records, we've got the S&P 500 records. Yes, there's been a little bit of a pullback recently. I noticed, in fact, where we are standing at the moment, yesterday we saw the biggest single day's upside for tech stocks on the NASDAQ yesterday this year. As I say, going back to what I was saying earlier, in some respects, this makes everybody feel pretty good. OK, the markets are happy with where we are. Yes, from what you've just said, it's because of elements of the support we don't really want to, one, see, and two, get used to. But how should we chase profits going into 2022?
I think to a certain extent, the game is a little easier because there are so many things that are quite clearly uninvestable. In other words, you don't want to touch them at all. Bonds would fall into that category. So the bond market's never been more expensive, and yet there's never been a greater supply of bonds at large. It doesn't make any sense. It's as if the laws of economics have been completely overturned. Bottom line is that interest rates are at their lowest level in recorded history, the lowest level in 5,000 years. That doesn't mean that the bond market is about to explode, but there's a phrase in the dealing rooms, people in dealing rooms will have used over the years, which is enjoy the party but dance near the door. If you don't need to own bonds, then we strongly suggest you shouldn't touch them with a barge pole.
That's an interesting quote. I think Chuck Prince from Citigroup was quoted as saying, you've got to keep on dancing so long as the money's going into the market. And I guess, as you say, that is probably pretty much where we are at the moment. We're all feeling a little bit nervous where we are, but we can't be out of the market for too long. Is there a line of stocks that you think we ought to own, or are you advocating, with this idea about inflation, are you advocating taking money out of traditional sort of risk assets and going to something a lot safer, gold, Bitcoin? I don't know how you feel about cryptocurrencies. You and I have spoken at length over the years about traditional investing. I don't think we've ever really spoken at length about the crypto market and how important this is. Just give us an appraisal of how you think we could be making sure our money is safe going into 2022.
So the best way I could answer that would be to describe what we do in relation to our own portfolios.
Please do.
Said, we don't touch bonds because we view them as frankly uninvestably high risk, virtually no yield, but extraordinarily high credit, inflation, counterparty risk. So by a process of elimination, that leaves the stock market as the major tradable asset class. Within the stock market, we have the luxury, because we're a small firm, because we're not managing billions, far from it, we can be very selective about what we buy. So we are classic value managers, we're classic Benjamin Graham value managers. So if you want to know the sort of the Benjamin Graham synopsis of how to play this environment, he basically said two things. He said, own quality businesses. In other words, don't buy rubbish, own quality businesses, and then don't overpay to own those companies. So you try and find an investable universe that matches your risk appetite. And then you just try and ensure that you have the discipline not to pay too much for it. That, in our world, basically invalidates most of the tech sector, because whatever you think of in terms of the quality of companies like Amazon, Netflix, and Google, and Apple, and et al., the reality is they're trading on very high multiples. We would find those uncomfortably rich businesses to own right now relative to companies in most other sectors. And the sector we particularly like on valuation grounds is the commodities real assets sector. And the great news there is that that sector is trading extraordinarily cheaply relative to other stocks, the stock market itself, relative to paper assets. The fabulous opportunity on the table for everybody right now is that real asset related companies, commodity related companies, have never been this cheap in at least 60 years. So just at a time when you might want to get enhanced inflation protection, inflation hedging for your portfolio, the market is giving these companies away. It's a fantastic opportunity. I don't quite understand why it's there, but we're happy to seize it with both hands.
What sort of resource stocks are we talking about here? Are you talking about minerals companies? I'm talking to a lot of mining analysts that are now saying electric vehicles are going to be the real, forgive the pun, a motor behind some of the pricing of this. And we're looking there about some of those minerals, perhaps possibly maybe that contributes to electric vehicles, the permanent magnets, the copper cabling, the various component parts you put into EVs. Is that something you like, or are you more traditional than that and you're going for things that reflect the need to house more and more people that are in the world? What's the resource favourite play at the moment?
I mean, we don't have, let's say, specifics. So for some time, we favoured the monetary metals, gold and silver, for precisely that reason, because they have been money good in the past. There's a possibility they may even return to some form of money backing the financial system in the future if we have a monetary system reset, which isn't unlikely in our view. But it goes broader than that. So in addition to the likes of gold and silver, we also see merit in just industrial cyclical and real asset commodities generally, so the likes of copper, for example. But it's a broader issue than that. We'd like to get broader based exposure to the commodities market, so a variety of industrial cyclical commodities. Basically, wherever the companies involved are trading at cheap multiples but generating lots of cash, ideally having little or no debt on their balance sheets. So anything with those characteristics is something that we'd be naturally inclined to look at.
Just one interesting point, actually. I want to make a very interesting point, I think, from about your positioning on techs and not wanting to go for that. I saw a great stat the other day to say that apparently pretty much every single tech IPO that's happened in 2021 provided profits at the beginning. But I think if you're still holding those, my understanding is, I think this was a Morgan Stanley report saying pretty much every single one is now gone into some sort of reverse gear, which underscores what you were saying about tech. Let's park that to one side. But I want to pick up on this point, if I can, about cryptos. As I said, we've never really spoken about this in depth. What are your thoughts on the crypto market? Up until the last sort of 6 or 7 days or so, Bitcoin had been going great motors. I mean, we'd had amazing returns in terms of some of the growth in the numbers for Bitcoin, Ether, and some of the other well-followed crypto currencies. Then came this big pullback for seemingly little or no reason. Are you involved at all in cryptos? If not, why not? If you are, is it a question of dipping a toe in?
We're not involved, to be blunt. It's not a sector that we claim to understand all that well. That doesn't mean that we don't think there's merit in it necessarily. It's just that we don't have that expertise to know exactly what to buy. We find it very difficult to value these currencies. So we prefer to go with something more tried and tested. And gold's been an alternative currency for 5,000 years. So we're quite happy using that price history as a pedigree behind it. But I think for people who do want to, for those people who've yet to engage in the cryptocurrency world, by all means, dip a toe in the water. 1 or 2% maybe of someone's net worth, but I think you should treat it, frankly, as play money to the extent that the moment you make the investment, you should be willing to write it off completely, because these things are terrifically volatile.
It sounds a bit like putting it all on black, doesn't it, really? You quite willingly submit yourself to the vagaries of the casino, but you've got to be prepared.
Or buying a lottery ticket, exactly.
Yeah, well, exactly, that's right, yeah. Just want to move on from those sort of currencies, those cryptocurrencies, into traditional currencies. What would you prefer holding going into the new year? You mentioned about the US dollar, and you're talking about that unbelievably crazy statistic that 25% of all dollars was printed last year. That just goes to underscore the amount of money that the authorities are putting into the market. Do you feel happy holding dollars? Let's face it, the Fed's not the only central bank that's been printing money this year. Indeed, they're all at it. So where does it leave us in terms of currencies?
We wouldn't feel particularly comfortable having significant exposure to any fiat currency. So I think it was Voltaire that said that all fiat currencies ultimately go back to their intrinsic value, which is zero. And obviously things ebb and flow, so there are bull phases and bear phases. But it seems to us, it certainly seems to me, that we are living through a period in financial history that's never quite been matched. That you've got effectively every major government, every major central bank printing money like it's going out of fashion, which to an extent it is. So the trick is not so much just to surf the tide, to surf the wave, but also to try and move money away from the more obviously risky elements of the market. So we'd feel uncomfortable having significant cash balances. We'd feel uncomfortable having a large amount of liquidity. It's always merited having dry powder, but I think that there are limits, given that there are heightened risks in terms of bank counterparties, and particularly the inflation risk that we've already alluded to. So if your question was, would I rather own dollars, sterling, or euros, or yen? I'd rather own gold.
Yeah. Okay. Just one final question. Again, I guess it's not necessarily something you're going to be able to give a precise end point to, but this time next year, do you see equity markets broadly where they are, higher, or substantially lower, having hit the buffers and having seen the markets appreciate just what a tight corner they've been in, and the fact that people want to avoid them in the future?
I mean, we're not a hedge fund, so we don't take short positions in stocks. So some of the trend following funds that we allocate to may well have short positions in equity indices or certain types of sector. On a valuation basis, I'd have to say I think there's a risk that the most highly priced parts of the market are going to be lower next year, and that would include the likes of the so-called FANGs, the likes of the major tech, the mega cap tech stocks, because they would have to grow their earnings to the sky to account for the current valuations in the stock market. That said, I'd also like to think with the following wind that some of the sort of companies whose shares we own, beaten down businesses in the gold and silver mining sector specifically, will be much, much higher next year. Logically, they should be, because their operating businesses are working fine. The stock market's yet to catch up with that. And because of the inflationary backdrop and the risk backdrop, we'd say there's a particularly promising future for those kind of businesses. But, this is a highly uncertain world. I don't think anybody alive, anybody in investment has ever seen this kind of pent-up volatility. So, to some people, I wouldn't even be recommending renewing a 7-day travel card.
On that point of logic, very briefly, logic seems to have gone out the window. Do you, as a market veteran, do you ever feel that you're beating your head against a bit of a brick wall sometimes in trying to find value in all these markets?
To an extent, but there are always some, particularly when you're a sort of a diehard value investor, there are always times when the market goes against you and you feel like, oh me miserum. But the bottom line is all you require is a bit of patience. The market ultimately recognizes the inherent value of businesses. So if you can afford to take the long view, just chill.
Yeah. Okay, wise words. Tim, look, it's a pleasure. Thanks indeed for joining us. It's been great to be able to catch up with you again with our look into the crystal ball for 2022. That's Tim Price from Price Value Partners. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.